It's the season for filing of income tax returns, and we have prepared a series to really help you navigate the process smoothly. From magical tools to key mistakes to avoid, we got you covered. Whether you are a first-time filer of ITR or an experienced one, this guide will make your ITR filing season easy and stress-free. So let's start with the basics first. What exactly is an ITR? An income tax return is a form that's used by taxpayers to report their annual income, expenses, investments and taxes paid to the income tax department. It's a crucial document that ensures that the government can assess and collect taxes accurately. Now, why is it necessary to file an ITR? Filing an ITR is a legal obligation for individuals and entities whose income exceeds the basic exemption limit set by the government. But beyond legality, there are several compelling reasons for you to file your ITR this season. First, filing an ITR acts as a proof of income, which is essential when applying for loans, credit cards, or even visas. Financial institutions and consulates often require ITRs to verify your financial stability and income consistency. Secondly, timely ITR filing also helps you to claim tax refunds in case you pay more tax than your actual liability in a given financial year. This also ensures that you do not lose out on your own hard-earned money due to overpayment. And thirdly, maintaining a consistent record of filed ITRs can also protect you during scrutiny by the tax authorities. It demonstrates your own commitment to financial transparency and compliance with the tax laws. Additionally, certain high-value transactions also require ITR proof. For instance, purchasing of real estate or high-value insurance policies often necessitates the submission of your ITR as part of your verification process. Now, it's important to know who is required to file an income tax return. If your total income or salary before deductions exceeds the basic exemption limit, then you must file an ITR. And this applies to all the individuals, including salaried employees, self-employed professionals, and also business owners. Additionally, if you are a resident of India for income tax purposes and own any assets outside of India, you are required to file an ITR. This includes being a beneficial owner or having any interest in an asset outside of India, whether it's an immovable property, financial investments, or any other type of asset. Furthermore, if you are an authorized signatory for any account that's maintained outside of India, you must definitely file an ITR. This rule ensures that individuals with financial ties abroad report their income and assets accurately, aligning with the total or the global reporting standards as well. Let's come to the documents part. What documents do you need to file an ITR? Before filing your ITR, keep the following documents ready so that it becomes an absolutely easy process for you. The first document that you need for filing the ITR is Form 16. From the current employer and from former employers if you have changed jobs in the middle of a fiscal year. PAN card, Aadhaar card are also must, and these must definitely be linked. Investment proofs, including both bank deposits, PPF deposits, etc. You can also mention your home loan interest certificates, insurance premium papers if any, while you're filing the ITR. Now, you must also know that which of the ITR forms are you required to file. The process of filing an income tax return differs for different individuals. There are several types of ITR forms, and each is designed for different categories of taxpayers. For instance, the ITR 1, also known as the Sahaj form, is for salaried individuals with an income up to 50 lakh rupees, while ITR 4 or the Sugam form is for those with a presumptive income from business or profession. You also need to choose your form based on your any other sources of income, residential status, and other factors as well. There are in total 8 forms of the income tax return catering to various taxpayers. Like I said, ITR 1 for salaried individuals with an income up to 50 lakh rupees only from one single source, while ITR 2 is for individuals and HUFs or the Hindu undivided families for not having the income from business or profession. ITR 3 is for individuals and HUFs again having income from a proprietary business or a profession. Then ITR 4 or the Sugam form is for presumptive income from business or profession. ITR 5 is for firms. They're also for LLPs and the AOPs. Now, ITR 6 is for companies excluding those claiming exemption under Section 11. Also, ITR 7 is for entities required to furnish returns under Section 139(4)A, 139(4)B, 139(4)C and 139(4)D. ITR V is the acknowledgement form. This is the verification form that all the ITR form filers need to submit right after you've submitted your own ITR. Otherwise, it will be considered incomplete for you. Next, let's find out which are the magic tools for filing your ITR that you will need. In this episode, we are going to be diving into the magical tools that make your filing income tax process a breeze. First up, Form 16. This is your trustworthy wand provided by your employer. It details your salary, deductions, the tax deducted at source, the TDS, and you should definitely keep this handy. Next, you have the Aadhaar card. Linking Aadhaar card with your PAN card adds that touch of magic, making verification swift and simple. Do not forget to mention your PAN card details as well. And this unique identifier ensures all your financial spells are correctly recorded. Then comes the AIS, or the Annual Information Statement. This is like a magical map. It shows all your income sources, including interest from savings accounts, dividends, and many more. Also, then there is this Form 26AS. This magical ledger shows that the tax you have already paid and also helps you avoid paying more than necessary. Use the ITR filing portal, and this enchanted gateway allows you to file your returns online. It's user-friendly, guides you through the process step by step. Finally, the e-verification tool. This magic seal confirms your own ITR submission, completing the spell. With these tools, filing your ITR is no longer a daunting task. Keep them ready, follow these steps and ensure a smooth, stress-free tax filing experience. Happy filing, and may your financial magic be strong. What are the key common mistakes that you should avoid making while filing your ITR, especially if you are a first-time filer of the ITR process? Well, I know it's a daunting task for first-time users to file an ITR, but we are here to help you to avoid some of the common mistakes. First one is incorrect personal details. One of the most common mistakes is entering your own personal details incorrectly, such as your name, PAN card, bank account information. Double check these details before submitting your ITR to avoid the process delays. Then, choosing the wrong ITR form. Selecting an incorrect ITR form is absolutely something that you should avoid. There are different forms for salaried individuals, business owners. Others, for instance, ITR 1 is for salaried individuals with an income up to 50 lakh rupees only from one source, whereas ITR 4 is for those with a presumptive business income. So ensure that you are reading through which is the ITR form for you and you're filing it in the right form as well. Next is not reporting all income sources. Many of us forget, even if we are salaried individuals, that we can have other sources of income. Say if you're investing your money, even if you're putting your money in a bank account, a savings account, even then the interests that you get on your saving account is a source of income, and you need to mention that. So your savings account details, your FD details, your PPF details, all of those are essential because these will need to be calculated for a source of income. So ensure that you are mentioning everything wherever you're getting some or the other source of income. Non-disclosure of these other sources of income can actually lead to penalties and scrutiny from the income tax department. Next is ignoring deductions and exemptions. Do not miss out on claiming deductions and exemptions if you're eligible for those. Deductions under Section 80C for investments under PPF, ELSS, or even life insurance or term insurance can actually significantly reduce your own taxable burdens. So be aware of the exemptions such as even HRA or an LTA to lower your tax liabilities. Next is not verifying the ITR. After filing of the ITR process, one actually thinks that you're done, but you're actually not done till the time you e-verify your own ITR process using your Aadhaar OTP, net banking, or send a signed physical copy to the CPC in Bengaluru. Unverified ITRs are actually considered invalid, and those can also attract penalties. Next, let's talk about the deadline. Do you know that your income tax return filing deadline is July 31st of every financial year? Now, in case you forget and you miss the deadline, you will have the opportunity to file the ITR for the previous year for the next 6 months until December 31st, but not without giving an additional penalty. So it's extremely important for you to file an ITR before the deadline. We've all been in a situation where we scramble at the last moment to file our income tax returns. But it is essential that you do not miss this deadline of July 31st. While we all file tax returns before the deadline, the last date for filing ITR varies depending on the category of the taxpayer also. So for instance, employees with fixed salaries and taxpayers, like I said, it is July 31st. Similarly, taxpayers who need to have their books audited but don't have to worry about the transfer pricing must submit the ITR by October 31st. So what are the big consequences if you actually miss this deadline? Even if you file an ITR after the due date, well, you can do that, but it can attract penalties and therefore some consequences. Failing to file the income tax return by the due date can actually result in penalties. If filed after the due date but before December 31st, a penalty of 5,000 rupees could be imposed, and after December 31st, the penalty rises to even 10,000 rupees. For those with an income below 5 lakh rupees, the penalty is capped at 1,000 rupees, and for those above it, of course, like I said, it is 5,000 rupees. Additionally, delayed filing also results in interest on the due tax under Section 234A. Persistent non-filing can also lead to further scrutiny, prosecution and penalties of up to 50% of the tax due, or even imprisonment ranging from 3 months to even 2 years, extending up to 7 years for severe cases. Do you also know that if you miss out on this deadline of July 31st and you needed to take some deductions and exemptions under the old tax regime, you might not be able to, because the default regime then is chosen is the new tax regime. And that's not all. You have the option to choose your tax regime only if you file the ITR within the deadline. So it's crucial to file your ITR before the deadline to avoid any penalties and limitations. 5 popular small saving instruments with tax benefits under Section 80C that you can take benefit of in case you're filing your ITR this season. Well, in this episode, explore these 5 very popular small saving instruments that actually offer you huge tax benefits under Section 80C of the Income Tax Act. First up is the Public Provident Fund, or the PPF. The government-backed savings scheme offers a high rate of interest of over 7.1% and is completely tax-free. Investments of up to 1.5 lakh rupees per financial year qualify for tax deductions under Section 80C. It's a safe, long-term investment option ideal for risk-averse individuals and also is a great form of investment for your retirement. Next, we have the National Savings Certificate, or the NSC. This is a fixed income investment scheme that also qualifies for a deduction of up to 1.5 lakh rupees under Section 80C. The interest earned is compounded annually and is also added back to the investment, which is also eligible for a tax deduction here. Thirdly, on our list is the Equity Linked Savings Schemes, or the ELSS. These are mutual funds with a lock-in period of 3 years, the shortest among all Section 80C options that one can really look at. ELSS offers a dual benefit of tax savings as well as a potential of higher returns due to the equity exposure. Now, you can invest up to 1.5 lakh rupees in a given financial year for tax benefits even in ELSS. The fourth instrument is actually for a girl child, Sukanya Samriddhi Yojana, or SSY. This is designed for the girl child's welfare. Contributions to this scheme are eligible for deductions under Section 80C, and the interest earned here is also tax-free. Now, this scheme has a high interest rate and also ensures financial security for the girl child's future. Lastly, we have the tax-saving fixed deposits. These FDs come with a lock-in period of 5 years and offer tax benefits under Section 80C. Interest earned is taxable, but the principal amount invested up to 1.5 lakh rupees also qualifies for a deduction. Now, if you're looking for ways to save taxes this ITR filing season without making any investments, you've come to the right place. Well, you must be wondering, how can you really save tax without making investment? Here's how you can do it. First up, we have the standard deduction. For salaried individuals, for a given fiscal year, you can claim a standard deduction of 50,000 rupees from your gross salary. This is simple, automatic deduction and also reduces your taxable income without needing any investment. Next, let's talk about the house rent allowance. allowance. HRA. If you're a salaried individual who is living in a rented accommodation, you can definitely claim the HRA to lower your taxable income. The amount exempted from tax here is at least of the following: actual HRA received 50% of the salary if living in a metro city and 40% for those living in a non-metro city, or the actual rent paid minus the 10% of the salary. Ensure that you have the rent receipts and a rent agreement to claim these benefits as well. The other way to save tax is also through the leave travel allowance, or the LTA. This benefit covers travel expenses incurred during your leave. You can claim the LTA exemption for travel within India twice in a block of 4 years. Remember, LTA covers only travel expenses, not accommodation or food. Employers often offer medical insurance premium reimbursement as part of the salary package. You can avail of this benefit up to 25,000 rupees for yourself and for your family members as well. For senior citizens, this limit can extend up to 50,000 rupees, and this reimbursement reduces your taxable income without having you to additionally invest anywhere. Do not forget the Section 80 TTA, which actually allows a deduction of up to 10,000 rupees on interest earned from savings account. This is a straightforward way to reduce your taxable income without any investment. Now, if you're repaying an education loan, the interest paid on the loan is fully deductible under Section 80E. There is no upper limit, and the deduction is available up to 8 years or until the interest is fully repaid. For homeowners, the principal repayment of a home loan also qualifies for a deduction under Section 80C. While the interest payment can be deducted under Section 24B, this can significantly reduce your taxable income.
For more informative videos like this, keep watching India Today News Mo.